Hello and good morning, listeners. Welcome back to Almus Market Mornings, your morning dose of global financial update with Jayaram Krishnamurthy. Now, folks, on Friday, we've had the weak US NFP numbers at 22,000 against the 75,000 expected, which basically led to the moves for the overnight markets as well as yesterday, where gold glittered quite well and even dollar saw some weakening, while euro and other currencies saw some strengthening. India witnessed certain good celebrations going on. It was Onam, it was Ganesh Chaturthi, and as well as Eid. So, folks, we are back post the festive season. And JK, what is your expectations on the or readings on the US NFP numbers, along with the expectations on the rate guidance by the ECB in this week?
Good morning, Shikhar. Uh, yeah, the market was prepared for a weak number on Friday, and of course, as we have been saying, the last jobs number and the inflation number this week, these are two numbers that will occupy Fed's attention before they meet on 16th of this month for their rate decision. And yes, the number was weak, much lower. The job creation was the lowest since October 2024. Now, the 3 month average job creation has fallen to 29,000 in the last 3 months, and this is as against 186,000 per month in 2024. Unemployment rate has gone to 4.3%. But actually, if you remove the rounding off, it's at 4.324%, and this is the highest since October 2021 as well. Now, there was also, of course, a slight upward revision to the last 2 months' numbers. Now, if you look at read the numbers along with the overall consumption in the economy, which is already down due to tariff-related price pressures, and if we add the further job loss fears among the public, it's actually going to push the economy further down. And probably this is the reason why Fed members could ignore the inflation impact of the tariffs and go for at least another two cuts this year, if not more. Actually, FedWatch tool shows that there will be three cuts this year and probably even 10% probability of a 50 basis point cut in September. So market should be prepared for that. And now, added to that, we will also have the Bureau of Labor Statistics going to publish a preliminary benchmark revision to payroll number for the entire period from April 24 to March 25. And this is because this is a calibration based on the weekly jobless claims data that which is more comprehensive compared to the current employment statistics, which has only a sample of 119,000. So this can be actually a revision that can once again push the market on the dovish side of the U.S. economy, and will have some implication for the monetary policy as well. Now, direct implication of the jobs market report. 10-year is now down 12 basis points from the high seen before the report. 30-year is more than 15 basis points. So even the long end is now reacting lower. Although the near end is actually lower because of the rate cut prospects. Now, moving away, we also had a couple of political, challenges in Europe and Japan. The French Prime Minister has been boosted in a confidence vote. President Macron will be choosing another PM, which will be the sixth change, rather the fifth change since 2022. France is struggling with 114% GDP, debt to GDP and fiscal deficit, which is well above EU threshold. Definitely, the country might be risking a rating downgrade. We also have had the PM of Japan quitting. I mean, strangely, this was done quoting a trade deal with US as one of the reasons. In any case, the market has also coming to the fact that there will be another leader chosen very shortly in Japan. So both these events, actually kept the dollar not falling so much after the jobs data because of some sort of a safe haven buying. And in fact, there is also a factor of a September tax remittances by overseas US companies who will be repatriating dollars to meet the tax obligations. So some temporary factors are holding back further big fall in the dollar, but the trend is very much in place. And once these factors are fully discounted, dollar is likely to test its cycle low at 96.38, and perhaps euro at 1.1850, because the underlying trend and broader picture is one of weakness in the dollar. And if you look at gold, it has continued to make new highs. Just to give you a perspective, rally that started early 2024, when the previous cycle high of 1920 was decisively broken. Now, if you see another 200 USD rally, you will actually see the gold doubling from the previous cycle high of 1920 in just 2 years. So that is a kind of rally that the gold has seen. Staying on commodities, so OPEC is boosting its output once again. This is happening even as the market is well supplied and the prices are at the lower end, but it is seen as an attempt to regain market share, which is lost to the United States and Brazil and other producers who have also recently raised production. In any case, it's a good news for oil importing countries like China and India, although India is still its own unique position, having continued to buy discounted oil from Russia, and because of that, facing additional tariff from the US government as well. So this is an important week now, because we'll have CPI number from India, CPI number from US as well. I don't think even if a CPI number from US comes a bit stronger, it's going to stop the Fed from cutting rate at least by 0.25%. And for India, I think market will not take too much note of this week's number. We'll probably look at inflation coming even lower, because there has been a big drop in the GST rates that will actually push down the prices across the commodities and consumption. So it paves the way for probably another rate cut by RBI when they meet on September 30th. So as I said, dollar has been moving lower, but probably at a snail's pace. On the rupee, we still not seen much of an impact from the dollar's move or a weak US employment data. We have our own issues, particularly on the trade side from US, where there is not been much of a progress. Although officials do remain optimistic about conclusion of a trade agreement. But officials are also pushing at a greater pace for concluding trade agreements with various other major economies like Europe. And possibly that's one of the ways in which market government is trying to diversify our exports. But all these measures will take some time, and in the meantime, market is still contending with lower exports in the coming 12 to 18 months, or maybe 6 to 12 months, and that will actually keep the rupee slightly on the weaker side because of the lack of supply. And also, as we know, the FIs have been a consistent sellers in the Indian market, and data shows that FI holding of Indian stocks is at a 13-year low as of now. So not a good setting for the rupee, but stability at the higher level of for the USD INR is what the central bank will be happy to manage. Thank you.
Okay, JK, that was really good. And yes, folks, we have certain updates this week. Primarily, the participants will be watching out for the inflation updates from India as well as from US. But as JK mentioned, even with slightly higher inflation uptick for the US, Fed may still go ahead with at least 25 basis point cut in the coming FOMC meeting. While in case of India, the inflation number may likely continue to be on the lower side, with other reforms like GST rationalization can also, keep a check in the inflation update for the Indian markets. Conclusion on the trade agreement side for our domestic economy against multiple trade partners internationally is still awaited, but still the market participants continue to, or they should continue to expect lower exports, at least in the near future, which can keep the pressure from the trade deficit side on the USD INR while the FI numbers continue to be on the lower side. The stats suggesting 13-year low holding of the FIIs on the international market front. We see the political updates from the France and Japanese nations have kept the uh, dollar weakness limited, and clarity on these particular directions would let the currencies move in the trending direction, which currently looks like of USD weakness. With the kind of macroeconomic updates, the job markets showing the way for the weaker setup. Job creation being the lowest in the last few months, highest unemployment since October 2024, and the kind of revisions in these data being anticipated. So that's it for today, folks. We shall come back again tomorrow with another round of updates. Thank you so much for joining us.